If you're a crypto-based investment fund or hedge fund and you've been shopping for D&O insurance, you've probably been hit with sticker shock. Why does D&O and E&O insurance for crypto funds cost so much? What's driving the price for insurance on crypto and DeFi? And most importantly, what can you do about it and find the best deal? I'm going to get into that, explain the situation, and give you a best practices approach to getting D&O and E&O coverage for your fund coming right up. Okay, before I get into what's driving the cost of crypto D&O insurance, can I ask you to do me a favor and hit that like button? That'll help signal to YouTube that this is good content and it'll help my channel grow. Thanks. Okay, if you're in the crypto hedge fund space and been shopping for investment managers insurance, a form of directors and officers or D&O insurance combined with errors and omissions insurance or E&O, you may be shocked at the pricing of coverage. Crypto-based funds or funds with crypto exposure are seeing the combination of very few insurers playing in this space and high premiums compared to other classes of asset managers. Why? Well, there are a few reasons which explain what may seem like price gouging to you. First, the D&O marketplace for all asset managers, as well as private and public companies outside of the financial services world, has been disrupted for the past several years. Prices are elevated due to poor claims experience in the past several years and continued growing litigation in the D&O market. Overall, there is limited capacity in the D&O marketplace, which is driving up pricing. Compounding the capacity issue is the fact that reinsurance companies, which is the marketplace where insurance companies to go and purchase insurance and spread their risk, are generally pretty conservative and they are not accepting crypto exposures from their buyers. This means that primary insurers who you buy insurance from cannot spread their risks outside of their balance sheets, which is a pretty risky proposition. Second is uncertainty. Crypto and DeFi lack historical track records, unlike other asset classes which have long known histories. So there's a degree of uncertainty of what may happen in terms of future litigation. Uncertainty is not good in the minds of underwriters, so they hedge their bets by offering limited capacity at high rates. Number 3 on my list is that underwriters perceive crypto and DeFi as high risk, so they price it accordingly to their perception. Number 4, fewer players. With a high degree of uncertainty, lack of reinsurance to spread risk, and the potential for high claims, many traditional insurance companies choose to not even look at crypto funds, so that leaves only a handful of global insurers that are willing to engage on these types of funds. It's a basic supply and demand problem. There's a reduced supply and an ever-increasing demand as more funds start up in the crypto DeFi space, so prices are going to rise. Okay, so I've painted a pretty bleak picture. So what can be done about it? My first suggestion is to work with a skilled broker who can access all of the underwriters in this space. Combined with that is to not shotgun your application out to more than one broker. Thinking that the more brokers you have working on your account is better is actually contrary to best practices. As I mentioned earlier, there are a limited number of insurers underwriting crypto and DeFi accounts. Having more than one broker trying to get to these underwriters only will cause massive and unnecessary confusion, and it actually lessens your negotiating power and leads to poor results. Part of our process is to engage all underwriters in the domestic, London, and Bermuda markets and host an underwriting call with interested underwriters and a client's management team. This call helps you highlight your fund and give underwriters the opportunity to ask questions not found on application forms and get comfortable with your processes and controls. It also gets underwriters' attention and interest in offering proposals. It's an important point of differentiation. To that end, we also recommend providing robust details on applications and documents and information requested. Don't think of information requests as a big pain in the butt. Instead, think of it as an opportunity to differentiate. Finally, I recommend being careful of non-rated startup insurers in this space. There are several insurtech firms marketing themselves to crypto DeFi firms for D&O, which is concerning to me. D&O Insurance is a long-tailed insurance product intended to protect your firm's decision makers and their personal net worth from damaging and expensive lawsuits. Does it make sense to go cheap here? I think it makes sense to work with insurers that have strong balance sheets, are rated and recognized by major independent rating firms, and can weather blistering claims down the road. Finally, be patient. Most of our deals are underwritten and priced in about 2 weeks from the time we submit applications to the market. But some do take a bit longer. Hang in there and be patient so we can do the best job for you. Wrapping up, I hope that gave you some answers on why D&O insurance in the crypto fund business is so expensive and how to deal with it. If you're looking for that skilled broker I mentioned earlier, let's chat. Below in the description box is a link to where you can book a call on my calendar. If you're early in the thought process of starting a fund, that's fine. If you're up and running and need insurance, that's great too. Finally, if I didn't answer a question you have in mind regarding crypto and DeFi, let me know. You can comment below or drop me an email. And please don't forget, hit that thumbs up button. Thank you.